This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Question 16. A numbers one last. What amount should be charged to the statement of profit or loss in the year ended 30th of June X9 for electricity? When you read it, the following transactions relate to Rashid's electricity expense ledger account for the year ended June X9. There was a prepayment brought forward. So at the end of last year, we'd overpaid electricity. We'd paid some of this year's. During the year, we paid cash of 5,400. At the end of the year, there was an accrual carried forward. We still owed for electricity. Now, I can't remember which question, but one earlier in the paper. How you do your answer is up to you. This one I will do as a T account, but you don't need a T account. It's speed and getting it right that matters. But if I did do a T account for the electricity expense, at the beginning of the year there was a prepayment. We'd overpaid. And if you overpaid a prepayment, we would have started with a debit of 550. So there's already 550 expense for this year, even though we paid it last year. During this year, we paid cash, credit cash, debit electricity, 5,400. Finally, at the end of the year, there was an accrual of we owe 650. If we owe 650, there's an extra expense for this year of electricity we've used but not paid for. You debit electricity, you'd credit accruals, 650, owing 650. And therefore, the total expense to the statement of profit or loss, 0, 0, I hope I've added up right here, 6,600. The answer is A. Now, as I said, I keep repeating, and I'm sorry, but it doesn't matter which way you do it, you don't actually need a T account at all. If you're prepaid last year, you've paid 550, which was this year's expense. This year we did pay 5,400 cash, but also there's 650 we'd used, but we haven't paid, and therefore was owing. So whichever way you think about it, the answer is A. Was it A? Yeah. 17. What figure should appear in the statement of profit or loss for the year ended June X6 for receivables expense? So here we're after the expense for irrecoverable and doubtful debts. And here, I mean, I do think it'd be dreadful to do T accounts. Always the total expense you're looking for. It's the cost of any irrecoverable debts that are written off. Together with the change in the allowance for receivables. So let's have a read. At June X5, the end of last year, allowance for receivables 39,000. At June X6, receivables total 517,000. It was decided to write off debts totaling 37,000, so immediately irrecoverable debts of 37,000, part of our expense. And to adjust the allowance to 5% of trade receivables. So I need a second bit of workings. The allowance we need at the end of the year, we want it to be 5% of receivables. Receivables, we're told, were 517,000, but we then decided to write off 37,000. And so the figure left for receivables would have been 480,000, of which we want an allowance of 5%, which is 24,000. So that's the allowance we want at the end of the year. But the figure in our expense account is the change in the allowance from what it was last year. And so the allowance at the start of the year, or end of last year, was 39,000. And so it could be either way. Sometimes we will want to increase the allowance. Here, we want to decrease it. So the decrease, the reduction needed, that is between 39 and 24, is 15,000. But if we're increasing the allowance, it's an extra cost. If we're decreasing the allowance, it's a saving. So it's costing us 37,000 for the irrecoverables, but we're saving 15 by reducing the allowance. The net expense, 37 less 15, is 22,000. The answer is C. 18. What amount should Valley report in its statement of financial position for accounts payable at 30th of June X6? What have they told us? They've said the total of the list of balances in Valley's payables ledger was 438,900. Remember, the list of balances that the accounts for Mr. A, Mr. B, Mr. C in our payables ledger. We've had somebody list all the balances and add them up. And they've got a total of 438,900. The following errors, didn't agree with the balance on the payables ledger control account. The control account, remember, is your total payables account. The actual T account where we do our debits credits. They've told us the 3 reasons, and we want to know what amount should we end up with for accounts payable. Now, because they've given us the total of the list, A, B, C, we have to check how will these 3 errors affect the list of individual balances, and see if we can put it right. Number 1, a contra of 980 was recorded in the control account, fine, but not in the ledger. Well, it should be in the ledger that Mr. A, Mr. B, Mr. C, and it would have affected that list. It means that one customer, contra, we would have reduced the amount owing by 980, or we should have reduced by 980, I'm sorry, and we haven't. And so the balance in the individual's account would be wrong. The total's wrong. The contra would reduce it by 980. 2, the total of the purchase returns day book was under added. Well, fine, the total would be wrong. It means our double entries are wrong. The payables ledger control would be wrong, but the list of balances, remember, for the individual accounts, we take each individual item in the day books. The total is irrelevant. So that error doesn't affect the ledger, the account balances, the total of the list at all. Number 3, an invoice of 4344 was entered in the supplier's account as 4434. Well, that is going to affect if the individual account is wrong, the total of all the balances will be wrong as well. So, wrong invoice. Which way round was it? We should have entered 4344 we'd actually entered 4434. And so we'd entered too much. We'd entered, what's the difference going to be? I should be able to do it in my head, but still, 4434 minus 4344, 90. Let me check I've got it the right way around. Was posted as that. Yes, so we've posted 90 too much. The balance will be 90 too high. The list of balances will be 90 too high as well. So the correct total, it should be 437830. Is that one of the answers? Yes, it is. It's D. Now, I know a lot of people don't like that sort of question. If you're muddled about the names of the books, then if you haven't looked at the lectures on books of prime entry, you should. Because once you're clear what the books are, no question's ever easy, but once you know what the books are, it should be straightforward. If you're lost on the names of the books, then I'm sorry, it becomes little more than a guess. 19. According to accounting standard number 2, which two of the following costs should be included in valuing the inventories of a manufacturing company? Well, remember, well, you've read the notes, no doubt. But when we're valuing inventories of a manufacturing company, we should include all costs of manufacturing, all costs within the factory. Let's run down them. Carriage inwards. Carriage inwards is delivery of goods coming into the factory. The delivery of our materials, effectively it makes the materials more expensive. It should be included in the cost of inventory. Carriage outwards, that's the cost of delivering goods out of the business, delivering therefore to customers. That's not a cost of making them. We don't include it in inventory. 3, depreciation of factory plant, factory machines, yes. It's an expense of the factory and should be included. Number 4, general admin overheads. Admin, things like the accounts department. It's not a manufacturing cost, we don't include. So it's 1 and 3, it's B. 20. What is Prisha's gross profit for the year? Prisha has not kept accurate accounting records during the financial year. She had opening inventory of 6,700. She'd bought goods costing 84,000 during the year. And at the end of the year, she'd 5,400 left in inventory. All sales are made at a markup on cost of 20%. Okay, well, what's the cost of what we sold? The cost of what we sold is the opening inventory. The inventory at the start of the year was 6,700, plus whatever we bought during the year. So the purchase is 84,000, less any inventory at the end of the year, the closing inventory, 5,400. So the cost of what we sold $85,300. That's the cost of what we sold. We sell goods at a markup on cost of 20%. So the markup, the profit we're adding on, is 20% of 85,300, which is 17,060. And there we are. What is the gross profit? 17,060. It's B. So that could have been a lot messier, in fact. That turns out to be very straightforward. Question 21 now, I think. Yes, 21. What was the company's capital structure at 31st December 2065? And the choices there, the share capital and the share premium. Well, a very standard question. You're certain to get one or two of this type. Let's check. You remember from the note, from the lectures, I always set it up in the same way. I have three little columns: number of shares, share capital, and share premium. And so the start of the year, the end of last year, start of this year, what's it say? Ordinary share capital in dollars was 125,000. How many shares? It was 500,000 shares of 25 cents. And there was a share premium account, a balance of 100,000. We want to know how capital and premium, what they end up with at the end of the year, so let's work through it in date order. In the year ended December X5, we made a rights issue of 1 share for every 2 held. Well, if it's 1 for every 2, it's 1 divided by 2 of the 500,000 shares in issue. So there'll be 250,000 new shares issued. The nominal value, they're always the same shares as what currently exist. So the nominal value is 25 cents. And therefore, to share capital, 250,000 25 cents, 62,500 is credited to share capital. However, they were issued at $1 per share. Well, the extra, the remaining 75 cents per share, is share premium. So 250,000 shares issue, the premium 75 cents a share, 187,500. So at that stage, we've now 750,000 shares in issue. But we're not there yet. It says later in the year the company made a bonus issue. 1 for 5. Well, remember, after the rights issue, there are 750,000 shares in issue. So 1 for 5 means we issue another 150,000. Whenever we issue shares, share capital goes up by the nominal value. Here, 25 cents. So 150,000 at 25 cents. 37,500. But with a bonus issue, because the shares were given free, there's no cash received, share premium falls by the same amount. And now it's just adding up. Excuse me. Share capital. What does that add up to? 62, 100, I think 225,000. Whereas share premium, 250,000. Is that a choice? Yeah, the answer is B. Number 22. Which of the following should appear in a company's statement of changes in equity? Number 1, total comprehensive income. Yes, it's split between the profit for the year, which increases the retained earnings, and any surplus on revaluation, which changes the revaluation reserve. So it will appear. Number 2, amortization of capitalised development costs. No. they'll have simply reduced the profit for the year, and the profit will appear. There'll be a note about amortisation, just to be as a note about depreciation, but it doesn't appear as a separate item on the statement of changes in equity. Number 3, surplus on revaluation. Yes, I've already mentioned that does appear there. And so the correct answer is C. 23. What should be the depreciation charge for the year ended December X5? And we're given the plant and machinery account at cost for the business. And we're told our policy is to charge depreciation at 20% a year on a straight line basis, with proportionate depreciation in the years of purchase and disposal, so month by month. Well, this is another one where there's more than one way of doing it. I'll do it the way I find the easiest. If you want to do it another way, fine, as long as obviously you can get the right answer and that you're quick. What I always do is just sort of work through in date order. You see, we're doing the year to December X5, so the year starts on the 1st of January, and the cost at the 1st of January was 240,000, and the cost will stay at 240 until we either buy some or sell some. Well, if you look at the dates, the first thing that happened was we sold some on the 31st of March. So it stayed at 240 up to the 31st of March, but then we sold some which had a cost of 60,000, and the balance went to 180,000, and it'll have been 80,000, 180 from the 1st of April until either we buy more or sell more. Well, the next date here is 30th of June, so it stayed at 180 to the 30th of June, and then we buy more for 160, and the cost went up to 340. And so the cost was 340 from the 1st of July until something else happens. Well, here nothing else happens. It stayed like that to the 31st December. Now, why have I done that? It's because now I can do the depreciation. Depreciation is 20% straight line, 20% on cost. So we started with 240. Depreciation will be 20%, but it was only 240,000 for part of the year, January, February, March, 3 months. And so the first 3 months, we'd have depreciation of 240,000, 20%, 3/12, 12,000. It then went to 180,000. So depreciation 20% of cost, but how long was it 180,000 for? April, May, June. Well, again, 3 months. And so the depreciation for that period, 9,000. Finally, it changed to 340,000, depreciation 20%, but how many months was it at 340? July, August, September, October, November, December, 6 months. And so the depreciation for those 6 months, I've got that in my head, 34,000. And so the total for the year, 12, 21, 55,000. D. Now, I said before we started, there's more than one way you can arrive at that figure. Some people prefer to do it differently. Well, I'm not going to talk through and confuse. It's entirely your choice. I find that the quickest. That would be messy if there were lots and lots of purchases and sales, but in the exam there wouldn't be. Anyway, there we are. 24. Over the page. What is Hassan's return on capital employed? And we've given up above extracts from the financial statements. Well, I'm sorry, this is one where it really is learning the rules. You must have learned the relevant ratios. The return on capital employed, we take the profit before interest and tax, or the operating profit, and we express it as a percentage of the total long-term capital which is your equity, your shareholders' funds, plus non-current liabilities. So what are the figures here? The profit before interest and tax is 10,200, straight from the question. The long-term liabilities, well, we've got equity, shareholders' money of 35,600, plus non-current liabilities, the loan of 6,900, and of course you put the token 42,500 it's given you. But what's that as a percent? %. See. 25. Which of the following statements about sales tax is or are true? Number 1, sales tax is an expense to the ultimate consumer of the goods purchased. That's true. I said before I started all of this, I can't give full lectures here. I can't lecture sales tax now, but there is a full lecture on the website. And the sales tax, it keeps moving through all the different businesses involved, but the person who suffers is the ultimate customer, you and me. Number 2, sales tax is recorded as income in the accounts of the entity selling the goods. No, it isn't income. They collect the tax, but the tax, they're collecting it for the state. So number 1, yes. Number 2, no. The answer is A.